Welcome everybody. Welcome to GAAP Dynamics World Headquarters in the booming metropolis of Midlothian, Virginia. We're going to try something new this week. We're going to do a vlog on the accounting issues surrounding the coronavirus or COVID-19. What we're going to do is I'll briefly kind of go through some of those accounting issues, my top 5, and then down below we'll have links to resources, our own blogs, publications from Big Four accounting firms, as well as e-learning that you'll be able to take for more information that we've produced. And before I forget, actually have a code. It's Go Away COVID-19. If you put that code in our Revolution, that's our online learning platform, if you put that in, all the courses will be 50% off for the month of April. This certainly isn't the March Madness that I had, or any of you, I'm sure, had anticipated. I thought I'd be watching college basketball and the Masters and all that good things, but unfortunately, life has thrown us this global pandemic, and I know it's impacting people all over the world. And I think before we start off, I just want to give my heartfelt thanks to all the people that really make this world go round. That's the doctors, the nurses, the trash people that pick up trash, the grocery store clerks, the first responders, and all those people that are basically put in harm's way so the rest of us can live free. And so thank you. Okay, I didn't mean to get emotional on that, but anyway, here we go. This is my top 5 accounting issues related to the COVID-19. First and foremost, I think we have impairment of non-financial assets. And really those are 2 ASC topics there. We have ASC topic 360. Now ASC topic 360 is for impairment of PP&E and intangibles with useful lives or finite lives. So these assets are being amortized. Now, those types of assets don't have to have an annual impairment test, but they do have what we call a trigger-based impairment test. And so this is probably just a helpful reminder that COVID-19 probably is a trigger, and you'll probably have to be measuring those assets for impairment. Now, the other thing I wanted to point out is, once you have that trigger, the first thing that you're going to do is compare your book value with your undiscounted cash flows. And those are your cash flows for your use. And those cash flows probably have changed. Good luck trying to estimate them. I'm not trying to say it's going to be an easy task, but you're going to have to forecast out your cash flows for that asset. And then if those undiscounted cash flows are less, that means you're not going to recover the book value, and then you need to lower it to fair value. More on fair value in a moment. Now, the other assets that we have to look at would be goodwill and indefinite-lived assets, intangibles. And these are assets, of course, you do not amortize, and so GAAP requires us to measure them annually for impairment, or, and here's the kicker, and here's why it's an issue, or when things come up that say that asset might be impaired. Now, ASC topic 350 does have that potential, that step 0, where if it's more likely than not that the asset is not impaired, then you don't have to do a test. And I'm sure many of you in a booming economy probably just rolled on last year, and probably at the end of the year if you measured them for impairment then. Obviously now things have changed, and so you might need to measure your indefinite-lived assets, intangibles, and goodwill for impairment again. And again, writing it down to fair value. Do not forget the new ASU 2017-4, which simplifies goodwill impairment that's applicable for public companies this year. And so remember, that eliminates step 2, so you don't have to kind of come up with a hypothetical purchase price or a hypothetical goodwill, but you do have to measure that reporting unit, if it's goodwill, down to the fair value. Also, do not forget the order in which you do these tests. And all of this is covered in various blog posts and e-learnings. The second accounting issue we have here is the valuation and impairment of financial assets. First thing I want to talk about is loans and receivables. As you know, the new CECL model, ASC topic 326, is, I guess, now applicable. There was a provision in the new COVID rule published by Congress where companies could delay, banks could delay the implementation of CECL until either December 31st, I think, or when President Trump declares the pandemic over. So watch this space. We do have a very good blog on ASC topic 326 and the accounting impacts on banks. But obviously, this idea of CECL, this idea of looking out into the future, expected loss model, I don't think any of your reasonable and supportable forecast predicted a global pandemic shutting down the world economy. And so you're going to have to go back to the drawing board and sort of, re-CECLify that, or re-estimate rather, for the COVID-19. We also have investments. Equity markets have dropped between 25 and 30% off their highs. And just a reminder that the new ASC topic 321, it governs equity securities, and if they have a readily determinable fair value, then you must measure them at the fair value and with any changes through the P&L. If you have an asset that doesn't have a readily determinable fair value, there is a measurement alternative, but again, that measurement alternative requires you to look at impairment, and this would be an indication of that. And so the same thing goes, I didn't put it up here, but ASC topic 323 for equity method investments in joint ventures, you need to look at that. Investments in bonds, debt securities, that's ASC topic 320 and 326. And again, if you've adopted CECL already, ASC topic 326, then the new impairment model applies there. Now, all of these things, both the first two impairments, whether it's financial or non-financial assets, really kind of hinge on fair value and what that is. And fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, there's a couple things, just a couple quick reminders related to COVID-19 and the issues that it brings up. First is this idea of market participant assumptions. When I teach a class, I always sort of say it's like a fight with my wife. And every time we have an argument, we don't ever fight, but every time we have an argument, she says, "Mike, it's not about you." And that's when I teach it. I say fair value is like that, just like my wife. It's not about you. I don't really care what you are going to do with that asset. I don't really care what you think you should sell it for. It's what a market participant would pay for it. And obviously now in this depressed economy, some might say we're already in a recession, that rears its ugly head. Now, some people argue, well, wait a second, it's not orderly. This is a dislocated market. Be careful. Even in the height of the 2008 global recession with regards to the mortgage securities and stuff, the FASB and the SEC said, hey, listen, as long as there's markets transacting, then it's orderly, and you cannot ignore those market prices that are coming out of there. So don't just sort of say, oh, it's forced, I can ignore it. That doesn't count. Finally, number 4, contingencies. Just a reminder, ASC topic 450 deals with contingencies. You are going to record a loss contingency when it's probable and reasonably estimatable. Now, that means it gives rise, it's a present obligation based on a past event that's both probable and reasonably estimatable. That means it meets the definition of a liability. And here's just a reminder that under US GAAP, as a general rule, you cannot accrue for future losses. And so even though you know that you're not going to receive rent because, the lessee has not decided to pay you rent, you can't accrue for future losses. Now, there are some exceptions to that, one being the next topic we're going to talk to, restructuring provisions and exit costs. And certainly in a business combination, that rule kind of is not applicable. Same thing with inventory. But as a general rule, you cannot accrue for future losses under US GAAP. And then the last thing I want to talk about, well, 2 things under contingencies. One is insurance recoverables. Many of you will be expecting insurance to reimburse you for some of these losses, business interruption or the like. First, be careful. not always, the global pandemics aren't always covered, so I think you might get screwed there. Secondly is, even if you are expecting an insurance recoverable, just a reminder that is a gain contingency under topic 450, and you can only accrue gain contingencies when they basically become a receivable. Okay, so you can't accrue them even though it's probable and reasonably estimatable. Gain contingencies have a much higher threshold. And the last thing with contingencies relates to disclosures. Just a reminder that the SEC wants you to wants your contingency disclosures to evolve, and so including amounts if you have them. And so don't forget disclosures when we talk about contingencies. And finally, the last thing I want to talk about is restructuring provisions and termination benefits. Unfortunately, when the economy goes into a recession, companies lay off people. My sister got furloughed from a job at a retailer down in Charlotte, and I just read in the paper Macy's is furloughing 125,000 people. So it sucks, and I'm sorry if you've lost your job as a result of this pandemic. But if you're a company, just a reminder that with restructuring provisions and termination benefits, there's really two rules you got to look at. One is ASC Topic 420. ASC Topic 420 is sort of the one-time termination benefits and exit cost. And then the other one is ASC Topic 712, which is sort of your contractual termination for an ongoing plan. And those two rules have different recognition thresholds. ASC Topic 420, the one time, you must have, and this is very important, you must communicate it to the employees and have a formal detailed plan that's been committed to by management. Now, for the contractual termination benefits, the premise is that it's already been communicated via a contract or a union agreement, and so the only thing you need to do there to accrue termination benefits is that it meets probable and reasonably estimatable. Now, there's a whole host of issues, other issues dealing with this global pandemic. We've put some of those resources down there. Some things that come to mind is foreign exchange, hedging, because your forecasted transactions may no longer be probable, deferred tax assets and really the related valuation allowances, inventory valuation, and then of course SEC reporting and disclosures in your MD&A and your risk factors. But that about does it. I see my timer's at 12 minutes, 13 minutes. It's probably already longer than I wanted it to be. Just a reminder here, again, the go away COVID-19. Go down to our Revolution and enter that code. You'll get 50% off all our online learning. There you go. The joy of live training with only me being the producer. And just a suggestion, when life throws you lemons, make lemonade. I've not seen more people. I've lived in my neighborhood for 8 years, and I haven't seen this many walkers and getting out and getting exercise and fresh air. We're doing family dinners every night, which is great to see our kids, and so I hope you guys stay safe, stay healthy, and stay home. But that's all for now. Thank you very much, and we'll be seeing you.